Hey everyone, I'm Misty Lynch with SoundView's April market recap. And if you've been watching your portfolio in the news this month and thinking, is this real? It is. April 2026 was one for the record books. The S&P 500 finished the month up over 10%, its best single month since November 2020. The index crossed 7,200 for the first time. NASDAQ hit all-time highs even after a rocky start to the year, and April completely turned things around. Now, I want to give you context for that number because 10% in 1 month is extraordinary. To put it in perspective, the stock market's long-run average annual return is roughly 10%. April just delivered an entire year's worth of average gains in 30 days. So the obvious question is, what the heck happened? And more importantly, what does it mean going forward? So let's start with where we were at the beginning of April. Coming into the month, the S&P was actually down 4% for 2026. There was real anxiety over the markets. Oil prices are elevated. Geopolitical tensions in the Middle East had investors and everyone else on edge, and tech stocks had been under pressure since late last year. Then something shifted. Earnings season kicked off, and company after company started beating expectations. Investors started focusing less on the headlines and more on fundamentals. And the market did what it often does when fear gives way to clarity. It moves very fast. So by April 30th, the S&P was sitting at all-time highs. The Dow surged nearly 800 points in a single session on the last trading day of the month. And now here we are in May. So what I think is really important is for us to walk through the things that actually drove this rally, because understanding the why is what's going to help us stay on course the next time volatility appears, which it always does. And the first force is earnings. Of the S&P 500 companies that reported in April, 86 beat expectations on earnings per share. That is not normal. That's a blowout. Companies are making money, and they're making more of it than what Wall Street predicted. When that happens across dozens of different sectors simultaneously, the market takes notice. The second force is AI and technology. I know you've heard about AI for the past 2 years, but what is different now is that we're seeing the earnings to back it up. Tech stocks, which technically lagged the market earlier this year, came roaring back. According to UBS, tech stocks accounted for 57% of April's rally, even though they only represent 35% of the index. Semiconductor companies, chip makers, data center businesses, all of them are printing money right now, and investors are pricing in more of the same. The third force is the Iran conflict de-escalation. The conflict with Iran has kept oil prices elevated, as we all know if we go to get gas this week, and it's created genuine uncertainty. But throughout April, investors started to believe, rightly or wrongly, that the worst case scenarios are off the table, that diplomatic signals improved, and that money that had been sitting on the sidelines started to make its way back into equities. The market is always looking 6 to 12 months ahead. So by mid-April, it started to price in a more stable world. And the fourth force is buying the dip. You've probably heard this term before, and it's one of the more behavioral than fundamental terms about why we should buy when the market pulls back. We saw it a lot in 2020. We saw it after tariff volatility last year. Retail and institutional investors have learned that dips are buying opportunities, and psychology creates that self-fulfilling momentum, and we saw it play out in April. Now, here is my honest take as an advisor. A 10% month is exciting, but it also demands some perspective. The S&P's valuation metric known as the CAPE ratio, which compares prices to long-term earnings, is now sitting at 40. The last time it was that high was 1999. Doesn't mean a crash is coming, but it does mean that the market is pricing in a lot of good news. So my job is to make sure that the portfolio is positioned to benefit from strengths like this, while not being overexposed if the narrative changes. Okay, now I'm going to put my tinfoil hat on for a couple of minutes because last week I was speaking to one of you and the topic of private equity came up. So I wanted to take some time to discuss it with you if it's been something you've been hearing or thinking about as well. Most of us hear that term and picture Wall Street suits, but I want you to know that private equity is quietly reshaping the businesses and experience that make up your daily life. And as your advisor, we should think about what it means and really kind of understand it better. So here's a simple version. Private equity is when a group of investors, often including pension funds, university endowments, high net worth individuals, pool their money together to buy companies that are not publicly traded on the stock market. Their goal is to buy a business, improve it, or scale it, and sell it for a profit, usually within 3 to 7 years. You can't just turn around and sell your PE investment on a Tuesday afternoon. Your money is committed for years at a time. One of the strategies they use is called a roll-up. Find an industry full of small independent operators doing roughly the same thing in different towns and buy up as many as you can, standardize the operation, and create one big valuable platform and then sell it. If that sounds abstract, let me make it very real for you, especially some of you who are in similar situation to me involving youth sports. If you have kids or grandkids in organized sports, you've probably felt this already. The youth sports industry is now a $40 billion market, and private equity is flooding in. The same investors who own the Philadelphia 76ers, Josh Harris from Apollo Group and David Blitzer from Blackstone, have been buying up baseball camps, flag football camps, youth leagues, tournament operations all over the country. They own the famous Cooperstown baseball complex where 12-year-olds go every summer as a rite of passage for that game. That feeling of community tradition, it now has some Wall Street targets attached to it. KKR is one of the biggest PE firms in the world, bought Varsity Sports brand, which makes your kids' sports uniforms and runs cheerleading competitions for $4.5 billion. Family spending on youth sports has risen 46% in just 5 years. And the honest concern from the community advocates is when private equity owns these programs, their mandate is to maximize returns, not necessarily keep prices accessible for every family. Another area is restaurants. If you think about some of your favorite restaurant chains, Blackstone just bought Jersey Mike's this year. Whataburger was sold to PE about 6 years ago. And consumers are noticing. They're literally comparing photos of their sandwiches before the acquisition and after to see if the portions have changed. This is how deeply people feel it when the brand that they love gets bought. Don't even get my mother started on Joanne Fabrics. But anyway, to be fair, PE investment has also helped chains grow and expand into new markets, survive downturns that they might not have otherwise survived. But it's a relationship to be aware of. Another space is veterinary and home services. These are two more you might not expect. Your vet from 2017 to 2022, private equity spent $45 billion buying up veterinary clinics. So your local vet might already be owned by a private equity platform and you might not know it. And your HVAC company, pest control, your plumber, PE has been aggressively rolling up these home service businesses. Steady demand, recurring revenue, and owners who might not have invested in technology for years is the perfect formula for them. So the bottom line on private equity is not inherently good or bad. It's capital-seeking returns. It's reshaping the landscape of everyday American life, and the more you understand it, the better questions you can ask as an investor. Will we be investing in it here? No. It doesn't suit our needs, our liquidity needs, things like that. It's not necessarily something that, but you are seeing it starting to, question if it could be opened up to 401ks and other platforms. So expect to hear more about this topic, and I will keep you informed. And the last one today that I want to talk about is brand new. So if you haven't heard about it, you're hearing it here first. The organization that manages the S&P 500 index, the S&P Dow Jones Indices, has officially proposed changing the rules about how companies get added to the index. To understand why this matters, let me remind you quickly of what the S&P 500 actually is. It's a curated list of 500 leading American companies. If you own an index fund, like all of us do, you own a piece of 500 of them weighted by size. And as a company gets added to the index, every index fund in the world has to buy it. That creates enormous buying pressure. The current rules to get in: your company needs to have been publicly traded for 12 months, have positive profits for the past year under standard accounting rules, and a publicly traded float of at least 10% of shares. Here's what's changing or being proposed to change. First is faster entry. The minimum time that a company has to be public before joining is proposed to go from 12 months to 6, which is a significant acceleration. The second change: profitability requirement could be eliminated. This is a big one. For decades, you had to be making money to join the S&P 500. That profitability requirement served as a quality floor. It kept speculative, money-losing companies out of the index. And that's an index that millions of us rely on. So under proposed rules, the requirement for that could be waived entirely for so-called mega cap companies. The third change is the float requirement being waived. The rule that at least 10% of your shares must be publicly traded could be waived for large enough companies. Now, why is this happening? The honest answer goes to another conversation I had with a different client last week. And it's that there's 3 massive companies that are expected to go public this year: SpaceX, OpenAI, and Anthropic. Together, they're projected to raise over $240 billion in IPO proceeds. SpaceX alone is targeting a valuation of over $2 trillion. These are transformational companies, but they might not be profitable on this basis, and they might keep most of their shares private. The rule would allow them to enter the index within 6 months of going public. So what does this mean for us as investors? 3 things that I want you to think about. First is forced buying. When SpaceX or OpenAI joins the S&P 500, every single index fund, including the ones in your retirement account, will be required to buy those shares. That could trigger hundreds of billions of dollars of buying pressure. Prices could move significantly just from that technical demand, separate from the underlying business value. The second quality filter is changing. The S&P 500 always had a profitability requirement because investors deserve some assurance that the companies they're buying through this index are actually earning money. Removing that requirement for large enough companies is a philosophical shift worth paying attention to. And the third is concentration risk. 10 of the largest companies already account for 38% of the entire index. Adding trillion-dollar companies that haven't proven consistent profitability deepens that concentration. Even if those companies stumble, the index is going to feel it. These rule changes are still in consultation, they're not final, but the direction is clear, and it's something that I'll be monitoring on behalf of your portfolios very, very closely. So, now that was a lot. April was a remarkable month, one worth celebrating in some ways, while staying grounded about what comes next. Whether it's understanding how PE will impact some of our own businesses and our communities, or watching Wall Street's most important index and how it could be evolving, it is our job here to make sure that you're informed, prepared, and positioned for whatever comes. As always, if this raised any questions or topics you want to talk about, I'd love to connect. Reach out, schedule some time, and let's talk. Thanks for watching. Take care of yourselves, and we'll talk again next month.